All right, welcome back. So in this video, I want to go ahead and explain to you a concept in DeFi, why you should never check the price itself of the asset, but you should dig a little bit deeper into understanding the capital efficiency. Okay? Because the top 1% of liquidity providers don't care where the market itself, where the price is actually going. We care about the capital efficiency and market structure. This is so important to understand, and the majority of DeFi channels, DeFi gurus and mentors and all of that stuff will never ever explain you this, and you will end up losing capital over time simply because you was not aware of this phenomena. And the mentors themselves, they also don't care about this because they are making money by selling you some sort of an access, right? Instead of actually deploying actively capital themselves for a full-time income. So this is the biggest difference, okay? So in a very simple perspective, right, the single biggest reason while retail liquidity providers lose money is that they approach a liquidity pool provision with a trader's brain. So the trader, right, always needs the asset to move from point A to point B. So they are betting on direction. So if we grab a simple, brush tool, for example. So a trader, they need, so for example, this is the current price path. So a trader needs for the price to go somewhere. In most cases, depending on what kind of a position they have, whether it's a long or short position, they will need for the price to go up or down specifically. So let's say the trader is long here. So the trader needs for the price to go up. It can take a while, it can swing, etc., but eventually it needs to go up, right? Or if the trader is short, he will need for the price to go down. So they are taking directional bets. They depend on direction of the market and their bet direction as well, whether they are long or short, whether they expect the price to go up or down. Now the liquidity provision, if we take the same betting approach, the liquidity pool and liquidity provision concept is like the casino itself. The casino doesn't care if their roulette lands on red or black, on 11, on 23, on 0, right? They just want the wheel to be spinning constantly. People come in and bet. They don't care where the ball lands. They don't need to make any directional bets, so to speak. The casino itself, they just need the wheel to be spinning. While those that come and bet, they are making directional bets, whether it's red or black or 11 or 23 or 34, it doesn't matter. They are taking the directional side. A casino itself, they don't need that. They just need for the wheel to be spinning. So the same thing applies to DeFi and markets, right? When we provide liquidity into the pools, we don't care if the price is going up or down. We care if the price is actually being traded, right? So as an LP, liquidity provider, you don't want the price to go to the moon. All you want is the price to get locked in a room, in a little box, bouncing off the walls, paying you every time, all the time, right? So while it stays within the room, within the floor and the ceiling, you are getting paid, right? Let me remove that and uncover this one. Okay, so a strong trend when the market is actually actively trending is liquidity providers' worst nightmare, right? And this is what the majority of gurus in DeFi will never tell you because they don't understand this concept themselves, right? We ran hundreds of thousands of simulations. We know every single possible scenario in DeFi and market conditions. We tested all the strategies on bullish conditions, bearish, sideways, massive bearish, massive bullish, late bearish, early bullish, late bearish, late bullish, it doesn't matter. Stairways, everything, millions and millions of data points, okay? So if the market is actively trending, is going up or down actively, right, making higher highs, higher lows. So what I mean is like the market is doing this, right, or this. It's the active trend. So this is the worst nightmare for the liquidity provider, because the impermanent loss will be extremely heavy. Your fee generation will almost never outpace the loss in asset value when a strong directional move happens, right? You will be earning the fees, of course, but the price will go down much quicker than the fees can generate themselves, right? But if the trends are the enemy, then choppy conditions, consolidation is your best friend, right? When the asset is choppy, it means the market is highly indecisive. It goes up 2%, then down 2%, then up 1%, then down 3%. So for a trader, this is like agonizing. This is the worst possible conditions. For a liquidity provider, this is the holy grail. This is what you want to be using. This is the time when you want to be in liquidity pool, actively yield farming, right? Not right here, because I saw enough videos and private community calls, mentor calls across the market. And when people are asking questions, what do I do if I have an impermanent loss because the market is going down and I am getting constantly out of range? The answer in most cases are simply, oh, well, just, it's normal. It's part of the game. Add more capital from your salary or something like that, which is completely, it's just such a massive lack and gap of understanding and knowledge from the mentors themselves, right? So anyway, this is the reason why looking at the price, what ETH or Solana or Bitcoin is doing is only important for the traders themselves, because they are making the directional bets. Us liquidity providers, we need to care about completely other things. So let me show you a bit what I mean. So for example, this is ETH, ETH USDC on base. So this is the smart contract address. You can simply paste it like that, and you will see the chart Uniswap on base. Even crazier, most of the times, mentors in DeFi space are actually showing you stuff on random charts, like for example, ETH USD dollars on Coinbase, where the chart is similar but not exactly the same. And if they start to apply some sort of a strategy for the range management, whatever, on a sex based chart, this is wrong, because chart on Coinbase moves differently than chart on for example, this one, right? Because you can see that on DEX, you have way more spikes. And this is the same asset, as you can see, ETH USDC on Uniswap, and this is the same on Arbitrum chain, right? On Base. But this one is on Base chain, and this is on Arbitrum. And as you can see, the charts are fairly kind of different, right? And this is Solana, and this is ETH on the Aerodrome on Base as well. So if you just look at the price and you want to start making some sort of a directional bets, well, you do that as a trader. As a liquidity provider, you have to look at a bit of different data, choppiness index, volume to a TVL ratio, etc., right? There's so much more important data for you to determine. So if we go to Solana, for example, in this case, and we are on a 4-hourly time frame, let me add one of the DeFi House chop strategy indicators. It's a custom built indicator. And the way it works, it measures the choppiness index, which is always available right here, choppiness index right here, and also measures the average true range, and then determines if the conditions are okay for you to be in a liquidity pool position, right? So for example, let me hide that one. In the current conditions, even though they may seem like a choppy market conditions, the choppiness index does not align, and the ATR does not align with the requirements for the market to say that, okay, we are in a choppy market conditions. So we don't have any active range at the moment. But when you do have, and when the conditions align, then you will get a start LP box that will give you the upper range and the lower range boundaries. You execute into this LP, in this case in a 50-50 proportion, and you essentially start yield farming, right? So in this case, on this example, you've stayed in range for 3 days and 20 hours, so pretty much 4 days. Okay, so you were able to farm some yield within this period of time because the conditions were okay. Then you had a few examples here. For example, this one was not the greatest one because you executed right here, and the market actually, even though you stayed in range for 1 day and 8 hours, more or less, right? The problem was that Solana actually went down all the time. The moment you entered, it went down all the time. So in this case, upon this exit, in this specific short-term liquidity provision, you would end up on a net loss because the Solana actually dropped faster. It dropped 7%, almost, yeah, like 7% from the entry price. And in 1 day, at best, you were able to yield farm with approximately what kind of range it is, 13% range. On average, it's about 0.2 to 0.3%. So in this case, you would end up with a pretty heavy impermanent loss, and it makes sense, right? Because upon the entry, your underlying asset, 50% of it actually went down, because right here you executed in 50-50 proportion. So if you had, let's say, 10k USDC, you bought 5k worth of Solanas here, and upon all the way down, you bought even more Solanas at a worse price, and the original 5k also depreciated in value by approximately 7%, and the fees only managed to generate you approximately, in this case, as far as I remember, it's around 0.2 to 0.3%. So this would be a pretty nightmare scenario for liquidity provider, right? So this is why just having this on a chart is not enough. Of course, you always have to make a bit of a more calculated decisions. This is more for like active short-term liquidity pools. Even though while you have your main ones, the big ranges, the specific asset ratios, etc., for a short-term yielding, this works, but requires a bit more attention. So in this case, it's not the most ideal example. This one would be really nice because for 4 days you managed to yield farm quite a decent amount of yield, and the directional bet was mostly sideways. In this case as well, it was beautiful. In this case as well, it started at here and it ended at here, pretty much the same value. So you only get gained in pure yield. So over the time, of course, these things averages themselves out, and of course everyone is different and they can go ahead and change the parameters themselves. On Solana, the volume is usually about 120, and the pool TVL is approximately 27 million. Okay, so we have, yeah, like 4 times the volume to TVL ratio, and you can play around about these things. Minimum chop to enter, it could be 65. Then in this case, you wouldn't have any positions for now, only one here. So the higher the choppiness ratio, the more strict the entry is. And in this case, as you can see, Solana was mostly trending and you would not have any entries at the time. Only one here, a bit over here as well, but that's a really directional one, so it's not the best as well. But the point I'm trying to get is that you have to look at different parameters. Most importantly, choppiness index, ATR bonds, and structure itself, rather than just the price. The price will not give you anything when you provide liquidity. You need to know the data, and to get the data, you have to do the research. And it's not as simple as just open up the Uniswap or Orca, whatever, any DEX, and just deploy capital into the pool, 50-50 ratio all the time, rebalance when it breaks the range, and theoretically you assume that you are earning the yield because you see the yield accumulating. But if you calculate the net result, your principal value plus the yield versus what you started principal value, in most cases you will see that you are in a net loss simply because of poor rebalancing methods, poor strategy selection, and when it comes to short-term liquidity provision, because I know that most people, especially younger audience, they just want as much as possible, as quickly as possible. So they will skip all of the wealth building strategies and they will jump straight to the short-term liquidity farming, highest APR pools, blah, blah, blah. So this is why I'm trying to educate people on these kind of scenarios. For long-term wealth building strategies, those are really boring. Those works. I know they work because I do that myself, actually, right? But for short term, you can't just look at price and determine, okay, so the price is now here. We had a bit of a sideways movement, so let me randomly plot a range like that, just a bit above, just a bit below, and hope for the best, because hope is not a strategy when it comes to liquidity provision. Hope is a strategy when it comes to trading, for most at least. And if we open up ETH, we had a bit more, as you can see, setups, and ETH is not as volatile, so you will get a bit of a better outcome from ETH. In this case, we do have the active position, as you can see. We entered here. This is your range. The volume TVL health is wrong because when you change assets, you have to change this as well. This is just for informational purposes. It does not do much. And as you can see, you are now in yield, in range, sorry, for the last 1 day and 8 hours farming, and the price remains within the same entry. So this is the golden scenario for liquidity provision. Here it was okay. Here it was also really nice. Here as well. Here as well. I mean, not the greatest. You entered here, exited here, so directional loss was approximately 6%, but you remained in range for about 6 days, not fully. So, well, you managed to get most of this directional loss offset in fees, depending on which pool you had, of course. This is okay, this is okay. Yeah, so this is way better performing than Solana, simply due to less volatility as the asset itself. The less volatile the asset, the better the outcome is when you provide liquidity in a tighter ranges. okay? And if we look at ETH BTC, for example, we don't have any entries for now. We had one here. It's a fairly rare occurrence due to the volatility and the choppiness index being mostly not high enough for the choppy conditions to be confirmed. So that is available inside. I mean, this one I will simply leave the link down below, and you can use this very simple thing for yourself. It's not the holy grail, but it will help you make better decisions for sure. We also have high frequency LPs, this one, and this is also for 4 hours or 2 hours systems. It also tells you when to exit and when to enter and when to exit the LP. This is way more aggressive. It uses way more math, gives you really tight ranges that you can use with, in some cases with leverage, in other cases just purely for yield farming. And as you can see, there is an active position right now, been active for the last basically since yesterday, just a bit more over 1 day. But this is a bit of a different strategy as well. Okay, yeah, so this is the video. Hopefully it's gonna be beneficial. Let's go back to 4 hours, because on this one you have to use 4 hours. It works the best on 4 hours time frame. Okay, so that is the video. Hopefully it will make way more sense to you right now when it comes to understanding that DeFi is not as simple as trading, where you just whatever you think is going to happen, or you even don't even analyze that, you just deploy capital randomly in 50-50 proportions. It's not always the case. The range selection boundaries are really important for short term, and the asset split and the range width is really important for a long term wealth generating strategies as well. So yeah, hopefully it's going to be beneficial. Once again, thank you guys for watching, and as always I will see you on the next video.